So, hey there. I want to talk about today about the first chapter of the book, and technically it's the second chapter, but I think he really gets into the information on the second chapter. We'll just call it the first chapter. But in this chapter, uh, actually, I'm already in chapter 4, so I kind of have to read back and see what he had written down, so I could, see sort of what things are important of the list, and you can see them on the screen. The things on the left are sort of the his chapters, the name of the chapters, and on the right is like a bit of an explanation, but it's more for me to explain it. Let's start. Market action discounts everything is the first point, and this is what is basically gonna be on everything that you see, either directly or indirectly, is reflected on the price, in the on the market, which could be fundamentally or like politically or psychologically. Sorry. For example, people are afraid and they will sell, right? Or Russia invades Ukraine, well, the prices are gonna drop off. Stocks and commodities in Ukraine probably because well, they might be at the same time. It's not really a good investment to invest in a country like Ukraine if there's a war going on. It's not really good. Everything else is just reflected in the market. Um, let's go to the second one, the price moves and trends. Basically, here he stated that when the price moves in a trend, it's gonna stay like that until like a real reversal pattern happens. And these things can happen because fundamentally, right? Because well, something fundamental happens, or it could be because of a worldwide war or energy crisis or like anything. It could be anything because it can go up as well, right? To a price movement. So, and also the cool thing is when you're like good at technical analysis, you should be able to really see like the early stages of a trend and when they're gonna reverse, right? So that's when you can hop in or hop out, depending on what you want. So his third point being history repeats itself. I think history has really showed that a lot of things repeat itself, from world wars to stocks. Basically, things repeat itself, which could be really useful for when like looking at these graphs. And basically, it's really hard to like fact check that stuff is gonna happen because it happened in the past. But basically, that's what technical analysis is. And I think it's cool because well, the only data we have is from the past. So you can only predict the future with the past, and even you could say, well, you can't predict the future with the past. I think you can probably because history repeats itself. But again, I'm not really a professor on this topic, so I'll just leave it for what he stated. Then I'll go over the technical and versus the fundamental forecasting, because these things are actually different kinds of forecastings, but fundamentally, there's a lot of overlap between the two. The big one being technical analysis studies market action, and fundamental analysis studies the economics of forces of supply and demand that causes price change, right? And I think both are pretty handy when you're really getting into stocks because both can help each other out pretty much. And then the other big one is really technical analysis focuses on the effect of market movement, and fundamental focuses on the cause of market movement, which is basically the same as the points I stated before. But yeah, there's a lot of overlap between the two, and yeah, I don't know. I have to see. I think technical analysis is cool, but fundamental you can really use it as well when making analysis. And then the fifth one being timing. These ones here he talks about the timing on when you really want to enter a market, because he specifically talks about people when, for example, there's a downtrend in a stock. People might really want to buy at the bottom and risk the stock going down even further. But because SB they have the biggest um, the reward risk to reward ratio, I guess, is higher because well it's at the bottom, so it's probably gonna have a really great effect of going up, and well because it's low, it's gonna you're gonna have more percentage when it goes up, right? And then you will have people who want to see sort of a reversal pattern happening, or you get people who really want to buy when it found support, and you also have people who only want to buy when they really see it moving past the price. It's, the price can go down, and people might want to buy, but when they buy at different times is actually quite crucial. Yeah, so it might not be the best option to always buy at the bottom, but I think I think all the ones are pretty good, and yeah, I think actually if you apply technical analysis to the chart, you can really make up when something's gonna happen and how low it's gonna go, because I've seen it happen before, which buying at the bottom can apply, and when there's a sudden downtrend, something like that might be better to watch for like a reversal pattern. So I think these different timings are pretty great. I think you should be able to use different ones and not always buy at the bottom, because I don't think that's a solid strategy. Now we'll go over to economic forecasting. So here we talked about the direction of commodity prices, and then he said that these commodity prices reflect on like if there's going to be inflation or like how the average market is doing. Commodities are like soft commodities and hard commodities, and then hard commodities are stuff like energy and metals. Soft commodities are stuff like agriculture and livestock. And basically, if the price goes up of any of these things, because, well, let's say the energy price goes up, so just cooling the meat off is gonna cause a lot of price change. Well, because it costs more energy to store those pigs or anything you're storing. It's gonna reflect in the price, and that's gonna cause inflation, right? But that's basically what it is. Another great example, I think, which is not from the book, but it's something I looked up online. It's basically how these sort of big companies, or I guess like real companies, set up these futures contracts. So let's say you have a breakfast cornflakes, a cornflakes company. Well, what does a cornflake company need? They need corn, so they buy it from a corn supplier. And what they will do, they don't want to have a different price for the cornflakes every week or every month. They want like one solid price for like at least 3 months, right? Because the buyer is not gonna. It's gonna be annoying for the supermarket to change the price every time. The buyer is gonna maybe not like it if it increases a whole at the same time. Um, so yeah, it's gonna be an agreement between the two. So what they'll do is they say, okay, I'll pay this amount for your corn in the next 3 months, and it could be that both parties actually can gain or lose. Because if the price of corn increases, well, then the corn producer is sort of uh, in bad luck, because, well, he'll lose money, right? He could have sold his corn for more to a different company. And the cornflakes creator, maker, breakfast supplier, the guy, could actually also lose money if the corn price decreases, because he agreed to buy it at a higher price, and then the corn dude is happy, which I think is pretty cool, because basically these contracts happen over most of the time like a month or 3 month period or even longer, which actually I'm not sure, but this is my own strategy or like prophecy, is that these prices can basically affect. Uh, if you look at these prices, you can actually like buy a lot of food of that product because you know it's going to increase. Because, well, you might be too late to actually buy the product or like the goods, for example, stocking corn itself or like a part of corn. You can actually, you're probably on time to buy actually a lot of cornflakes, and you're probably might sound like a bad idea, but I think it's good. It's not a good business model, but I guess it's true. Well, and the last one is going to be self-fulfilling prophecy. Um, and I'm not sure what this. He did have a lot of points on why this is not true. For example, about the timing of the markets, about people stepping in. But it might be true. I'm not really sure yet. But basically, because he created these patterns, or not he, but these patterns were created, people started using them, and because everyone is using them, that's why they work. And that could be the case. I'm not sure. It could be. But I think the biggest example here is because I've heard it multiple times before. It's with one indicator, which or like a pattern. Sorry, I forgot the name. But it's the one of like a .5 and .36 and .21. That one. I'm not sure how it's called again. But yeah, That could be a self-fulfilling prophecy, but I don't think it applies to the rest. But it could be, but I think it's also hard to prove that one. But yeah, so that's it.